China is very misunderstood. Now, one of the main reasons for this is geopolitics. The US has declared China the main so-called threat to its global dominance, and for many years now, the Western media has been extremely biased and has spread a lot of disinformation about China. And these days, to be considered a so-called China expert in the West, really the only qualification that you actually need is to be anti-China. You don't have to actually visit the country or speak the language. But even among scholars and analysts who are a bit more neutral, there are still a lot of misconceptions about China, and especially about its economy. One of the narratives that we've heard again and again is that China abandoned socialism and adopted capitalism. This is completely wrong. It is false. Today I'm going to be talking about how China's socialist system actually works, and how, despite the fact that China does have private companies, it does have markets, it does even have a stock market, the system is still socialist. Now, a lot of this confusion is due to the reforms that were implemented starting in 1978 under the Communist Party leader Deng Xiaoping. Now, the simplistic narrative goes something like this. When the Communist Party leader Mao Zedong died in 1976, the reformist Deng came to power in 1978, and he implemented what was known as the Reform and Opening Up. And supposedly, this lifelong communist, Deng Xiaoping, who joined the Communist Party as a young man and spent his entire life building the Communist Party of China, for some reason, he just decided to abandon socialism and adopt capitalism. Of course, this is completely misleading. This is not what happened. Instead, Deng recognized that China was still very underdeveloped and needed to advance the productive forces and really industrialize. Because before the revolution in 1949, China was one of the poorest countries on earth. China had a life expectancy of just around 32, 33 years. However, as of 2022, China's life expectancy has increased to 79 years, which is more than even in the United States. So China has made incredible progress in economic development. And this was based on the gains of the Mao era, in which China implemented the beginning of industrialization and comprehensive land reform and basic education. But by the 1970s, China was still very much behind. And Deng Xiaoping recognized that in order for China to catch up in industrial development, it needed to allow some market forces. Instead of planning the entire economy like the Soviet Union did, China will instead only plan parts of the economy, the most important strategic elements of the economy, which are known as the commanding heights. But Deng was not arguing that socialism was a failure. On the contrary, he famously said, quote, "Since socialism is superior to capitalism, socialist countries should be able to develop their economies more rapidly than capitalist countries, improving their people's living standards gradually and becoming more powerful." And he noted that Marxists have always held that socialism is superior to capitalism and that socialist countries should be able to develop their productive forces more rapidly than capitalist countries. And he criticized the Gang of Four for having an ultra-leftist view that was preventing China from further industrializing. So China did not abandon socialism. It's, of course, still today governed by the Communist Party. But China did pursue a different model from the model of the Soviet Union. In the USSR, the entire economy was planned by the state and publicly owned. China instead took a different approach, and China said that the most important elements of the economy, known as the commanding heights, should be owned by the state. And still today in China, they are. The banking sector, all of the major banks are owned by the state. All of the land is owned by the state and leased out. And about 1/3 of Chinese GDP comes from state-owned enterprises, and they are concentrated in the most important strategic elements of the economy, including finance, infrastructure, construction, metalworking, mining, and other natural resources, including telecommunications, including some very important strategic industrial sectors. These are all publicly owned parts of the economy that are run through state-owned enterprises, SOEs. And China has been remarkably successful. It is the world's largest economy, according to data from the International Monetary Fund, and it overtook the United States as the world's largest economy in 2017 when you measure GDP at purchasing power parity, which is the best way to actually understand the size of an economy and not simply convert everything to US dollars at market rates, which makes the US economy look bigger than it actually is. Moreover, China has lifted 800 million people out of poverty. This is the world's greatest poverty reduction campaign in human history. And in fact, China has been responsible for nearly 3/4 of the entire world's reduction in extreme poverty in the past 4 decades, according to World Bank data. Now, some people might say that this is because China restored capitalism, but it fails to explain why the vast majority of countries on Earth are capitalist, including the vast majority of poor countries in the global South. Almost all of them are capitalist, and yet they still are extremely poor. And in the 1980s, China's GDP per capita, measured at PPP, was lower than capitalist Haiti, and capitalist Sudan, and capitalist Honduras, and capitalist Philippines, and yet today, China's GDP per capita is several times the size of the GDP per capita in those countries. But they're all capitalist countries. So if China simply restored capitalism, that's all it needed to do. It was just magic. The free market made China prosperous. Why hasn't it made Sudan and Haiti prosperous? And it's not just GDP growth, because your economy can grow rapidly, but if that GDP growth is not shared and distributed equitably, all of that GDP growth can go to 1% or 5% of the population. Well, meanwhile, in China, wages have skyrocketed. And if you look at Southeast Asia, China's wages in the manufacturing sector are now several times larger than wages in countries like India or Thailand or Malaysia or the Philippines, despite the fact that just 3 decades ago, China had the lowest wages in the region. By far, the largest companies in China's economy are the massive state-owned enterprises. If you look at a list of the Fortune Global 500, these are the 500 largest companies on Earth by revenue. 136 of those companies were Chinese in 2022. That's a lot. That's over 1/5. And the vast majority of those Chinese companies in the Fortune 500 are state-owned enterprises. 71% of the total number of Chinese companies on the Fortune 500 are SOEs. 78% of their total revenue comes from SOEs, and 84% of their assets belong to SOEs. And where are those Chinese SOEs concentrated? In the commanding heights of the economy, which remain publicly owned, including financials, materials, energy, engineering and construction, industrials, even motor vehicles and parts, transportation, aerospace and defense, chemicals, technology, healthcare, telecommunications. These are some of the major sectors where massive state-owned enterprises still dominate in China's economy. And in fact, hawkish think tanks in Washington, D.C., they constantly criticize China's SOEs for supposedly being unproductive and inefficient, because if you look at profit margins by country among the Fortune 500 companies, you can see that China is at the bottom of the list. That Chinese SOEs, although they are profitable, are not nearly as profitable as private for-profit companies in other countries, because these think tanks in Washington, what they don't understand is that Chinese SOEs are not dedicated to making profit. They are dedicated to serving the strategic interests of the Chinese people and help to maintain macroeconomic stability in China. That's why it's so laughable to see these charts published by Western think tankers who complain that the average profit margin of Chinese companies on the Fortune 500 is nearly twice the size of the profit margin of SOEs. Again, the point of SOEs is not to maximize profits. A major reason why there are so many misconceptions about the reform and opening up process initiated by Deng Xiaoping in China in 1978 is because so many foreigners have fixated on the statements of Deng Xiaoping, but ignored other major Chinese leaders. And while the name Deng Xiaoping is very well known, the name of probably the second most influential figure in China during the reform period is almost never heard, and that is the name Chen Yun. He was also a reformist like Deng, and he had been a lifelong communist, a lifelong cadre and leader in the Communist Party of China. But he also believed that China should have some market elements in a socialist market economy. And he created the idea of what was known as the birdcage economy. His idea was that the Chinese state would allow markets to exist and to function and use markets as a tool to try to develop the country and industrialize. However, markets would be like a bird in a cage, and that cage could expand or contract depending on the needs of the Chinese people, but the bird would never be let out of the cage. This was referred to as the birdcage economy, and still today, this is how the Communist Party of China thinks about markets. The World Bank published a study in 2019 that tried to answer this question: how much do state-owned enterprises contribute to China's GDP and employment? And it noted that in 1998, the World Bank broke down China's GDP into three segments. 37% came from the state, 12% came from collectives, and 45% came from the private sector, including rural households. Those are not big companies. Those are just small farmers, largely. More recently, economists estimated that as of 2015, SOEs made up around 39% of China's GDP. And as of 2017, the World Bank estimated that SOEs made up 23 to 28% of China's GDP, including 39% of industrial assets, 23% of industrial sales, and 18% of industrial employment. So SOEs make up at least 1/4 of the Chinese economy, although this is probably a conservative estimate, partially because sometimes it's difficult to measure what is a private company and what is a public company in China, given that just because the state isn't the majority shareholder in a company, the state also often has what's known as a golden share. So it might only have a minority stake, but the state has important veto power over decisions made by the company. So some economists have made estimates that are even higher than 1/4. I think a lot of economists would agree that roughly 1/3 of Chinese GDP comes from SOEs. But it's not just about the number, the percentage. More specifically, it's about what sectors of the economy are the SOEs concentrated in. And they are the commanding heights, the most important strategic sectors. And in recent years, in fact, SOEs have been gaining more influence in the Chinese economy. Now, previously we looked at the data from the Fortune 500. If you simply look at the top 100 listed firms as companies in China by ownership, and if you look at it by market capitalization, you can see that from 2010, private companies increased from about 10% of the total to about 50% of the total. But this is not GDP. This is only the market capitalization of the top 100 listed firms. That is stock market value. And since 2020, that figure has been declining and SOE's share has been increasing. And there's an important detail about this chart that you should keep in mind. It doesn't refer to private companies, it refers to non-public economies, and this is based on what the Communist Party itself in China says. This is the language that it uses. It doesn't say private and public economy. It says the public economy and the non-public economy, which clearly reflects the socialist orientation of the Chinese leadership. Deng Xiaoping never said that China was capitalist. In fact, he said that China's system was what he referred to as socialism with Chinese characteristics. He argued that each country has its own unique material conditions, and it should not simply borrow the model of another country like the Soviet Union, for instance. Instead, it should try to experiment and be pragmatic and see what policies work best given a country like China, for instance, which was still very agrarian, with most of the population living in the countryside, and still did not have significantly developed industrial manufacturing production capabilities. This was later updated in 1992 under the Communist Party leader Jiang Zemin, who announced that China had created what he referred to as a socialist market economy. This is the term that the Communist Party still uses today, noting that China is committed to building a high-level socialist market economy, laying the foundation for high-quality development. That's their words. Now, some analysts who know about Chinese history might know that in the 1990s, there was partial privatization of some of the state-owned enterprises in China. And this is taken as evidence that China adopted capitalism. But again, this is very misleading because it is true that China privatized some small SOEs, but at the same time, China consolidated state control over the largest strategic SOEs as part of a policy implemented under Jiang Zemin, which was known as grasp the large, let go of the small. So what were the large? The large were the major SOEs in the commanding heights of the economy in things like banking, finance, infrastructure, construction, metalworking, mining, energy, telecommunications. All of those SOEs remained in state control. However, some unprofitable SOEs in less strategic parts of the economy were privatized. In some low-level manufacturing for consumer goods that were not seen as strategically important to the overall stability of the economy. Or, for instance, China still had many SOEs in hotels and restaurants. Those are obviously not important strategically for China's macroeconomic conditions, so they allowed the privatization of some of those less important SOEs. But still, again, the stated policy of the Communist Party was grasp the large, let go of the small. It was not privatize everything and allow the free market to take control. That's not what happened. China's SOEs were explained very well in a report by a Princeton University researcher, Kyle Chan, who does very good research on China's industrial policy. And this article is titled Managed Competition in China's State Firms. He noted that the point of Chinese SOEs is not to maximize profits like private firms, but to support the broader economy as well as China's national interests. And furthermore, these Chinese SOEs are part of the upstream industries. They control the upstream industries, and that helps a wide range of downstream industries like real estate and electric vehicles and shipbuilding. They benefit from the commanding heights of the economy being publicly owned and therefore production costs being reduced. Furthermore, Kyle Chan, this researcher at Princeton, pointed out that while China does allow competition and markets, the Communist Party tries to avoid what it refers to as, quote, excessive competition or vicious competition. He refers to this as a Chinese system of managed competition, and he summarized it very well. He said, quote, in other countries, that is in capitalist countries, the state is seen as a tool to make markets work better. Like in the US, the government exists to serve markets and private companies. Whereas in China, markets are seen as a tool to make the state work better. And more specifically, I would add, markets are a tool to serve the interests of the Chinese working class, not the interests of Chinese capitalists. There are Chinese capitalists who exist, but they don't control the state, unlike in the US, where the state is controlled by big corporate interests, big capitalists. In China, capitalists are subordinated to the state, and private companies have to serve national interests on behalf of the people. And if they don't, they face very serious consequences. The Western media has published article after article crying over the poor billionaires in China that are supposedly being so mistreated. And the reality is that if you are a corrupt billionaire in China and you commit crimes, you will face very serious consequences, up to and including capital punishment or imprisonment for decades, or losing all of your wealth being confiscated by the state. Unlike in the US, where billionaires commit crimes all the time and then they bribe politicians to give them more and more government contracts. There have been many reports in recent years complaining that billionaires in China are losing billions of dollars in wealth. So I've explained how China's socialist system works and how China's state-owned enterprises provide the base upon which the superstructure of the rest of the economy is built. So now I want to talk about how China's stock market works, because this is something that also is confusing to people who say, how can China be socialist if it has stock markets? Well, the easiest way to answer that question is simply to look at the most important Chinese stock market index, the CSI 500, which is the Chinese correspondent to the S&P 500 in the US. And if you look at a chart, you can see pretty clearly that the stock market has basically been flat, pretty stagnant for 20 years. There was a bubble that burst in 2015, and since then, if you have invested in the Chinese stock market, you have probably lost money. And this is going back decades. In fact, foreign investors have constantly complained that it's very, very difficult to make money investing in Chinese equities, because in reality, the stock market in China is not very important for the overall economy. Compare this to the most important US stock market index, the S&P 500, and you can see that in the past 30 years, it is up over 600%. The US government has dedicated itself under Republicans and Democrats to pumping up the stock market as much as possible, because all of the wealthy oligarchs in the US who fund US politicians have their wealth invested in the US stock market. It's even more striking if you look at the NASDAQ, another very important US stock market index, which is more heavily weighted toward the tech industry. In the past 40 years, the NASDAQ has gone up over 7,000%. This is especially the case since the 2008 financial crisis. It has exploded, and this makes the dot-com bubble of 2000 look like completely insignificant. This is how much the US economy has financialized, because for mainstream economists in the US who help to run US government policy, they consider the stock market's health to be equivalent to the health of the US economy. For them, the stock market and the economy are the same exact thing. But look at China's main stock market index, the CSI 500. It has been basically flat now for 2 decades. Compare the growth or lack thereof in the Chinese stock market to Chinese GDP, PPP. It has increased by 100 times in the past 40 years. As of 2024, according to the IMF, China's GDP, PPP, was $35.3 trillion. Back in 1980, China's GDP was $302 billion. That is an increase of 100 times in 40 years. So here you can clearly see that in China, the stock market is not considered the same thing as the economy like it is in the US. And although there are 3 stock exchanges in mainland China, in Shanghai, which was opened in 1990, in Shenzhen, which was also opened in 1990, and in Beijing, which was opened more recently, the reality is that those stock markets are not very important for Chinese companies because they don't really raise much capital on the stock exchanges. Instead, they get capital from the state-owned banks. The 4 largest banks on earth by assets are Chinese state-owned banks. Together, they have roughly $20 trillion of assets. And these banks are what oversee lending to private companies. In the US, if a private company wants to make investments and expand production, they borrow on Wall Street. They use capital markets. In China, if a private company wants to make investments, they borrow from the state-owned banks. So even if a company is not officially a state-owned bank, even if it's private, it's still ultimately the state, through the state-owned banks, that decides where credit is going to be directed. So this is another way in which China's socialist system can help to guide the economy in strategic directions. And this means that the Chinese state-owned banks can discourage speculation and investments in creating financial bubbles. In the US economy, many big companies often don't even invest. Instead, they spend trillions of dollars buying back their own stocks to try to inflate their stock value because corporate executives get bigger and bigger compensation, bonuses based on stock value. And Goldman Sachs estimated that in 2025, US stock buybacks are going to hit $1 trillion. The New York Times reported in 2023 that US companies spend roughly 90% of their earnings on buybacks and dividends. That is, enriching shareholders and executives. That means that they spend a maximum of 10% on investment. And this is a reason that big companies like Boeing have been completely disastrous, because they simply do not invest in maintaining production, in more capital stock, in training workers, in safety. They spend 90% of their earnings on pumping up their stock and enriching shareholders. This is an example of how capitalism in the US is cannibalizing the economy. It is being devoured from within by these capitalist oligarchs who only care about their stock market value, because this is what the US economy is based on. It's a financial casino. Everything in the US economy is about the stock market, which is why so many Western analysts, they can't understand why in China, the Chinese government ultimately does not care about the stock market. I want to play a clip here from CNBC of a Western financial analyst admitting that China's socialist system is not about inflating the stock market. This is a very interesting clip. Check this out.
Do they really care about international investors? Do they really care about the stock market? I mean, let's ask that dangerous question, because the thing is that coming from the West, particularly the US, where the stock market is so tied up with consumer confidence, it's so tied up with the concept of wealth effect, it is one of the many focuses, the prime focuses of the Federal Reserve and the whole of the sort of system, if you like. In China, companies don't need capital they're getting their capital from cash flows. They're getting their capital from the sort of the private side. So the stock market doesn't provide the same sort of service in China that it does. Now, it will do. I think the key here is it will do.
The people. For political stability, you need the people to think that they can be aspirational and to be able to increase their net worth and then consume if you're trying to shift into a consumer-driven economy. You need there to be an acceleration of equity markets. You need property values to increase. It doesn't have to be exponential and, up and to the right. But don't you need that to happen? And that international investment helps that along.
Well, I think this is the central dilemma, is that the West basically has spent years assuming that China was just another emerging market, and it was going to do exactly the same, and it was going to drive everything with lots of borrowing and lots of leverage, and the sort of the Wall Street and the, if you like, the Washington consensus. What Xi told us 2 years ago was that's not what they're going to do. They're not going to privatize and create a whole lot of monopolies, which will allow massive rent extraction and very attractive profitability for corporates that we can all invest in. They don't see that as the role of the stock market or the state. The state is there to provide, as it said, common prosperity. The thing about China is they tell us what they're going to do. They told us 2 years ago that they were going to deflate the bubble in the housing market, not in the market, but in the developers. But we kept on buying the stocks in the developers. We kept on buying their overseas debt. And then we turned around and said, how's China done this to us? It needs to support this sector. And we know it works in the West. The politicians say, OK, yeah, we'll put lots of public money in to bail out the follies of the private investor. But in China, they basically said, well, we told you this was going to go. You're down 95%, sorry. But it's not that we're doing it deliberately against you, but we were just, we told you what our priorities are. So I think there is value in China, but I think we have to understand that they're not following our script. And I think that's where we've been missing, I think. And their growth is coming from other places. And they're going to grow their financial sector as a pension and a saving system, not a speculation and effectively selling it off to overseas investors like other emerging markets have been forced to do system.
It's always funny watching these interviews with Western financial analysts because they are coming so close to acknowledging that China is socialist. This myth that China restored capitalism under Deng Xiaoping is nonsense. And he's all but saying it in words there. There are so many examples of clips like these. I'm going to show another clip here, which is from Bloomberg. And you can hear another financial analyst complaining that the socialist government in China does not care about the stock market at the end of the day.
Have they even begun to make the shift toward a more Western market society from what we knew 20 years ago?
No, not even close. And they're actually on a treadmill walking backwards. I'm going to say something that's going to surprise you guys and probably everyone else. They don't think they're doing that bad a job. And here's why I say this. They don't really care about the stock market. Wall Street cares about the stock market, so they write a lot of notes about how important the stock market is, but Xi Jinping doesn't care about the stock market. When you look at the economy, they used to prioritize high levels of growth. They're not doing that anymore. They're worried about national security priorities like, creating a chip ecosystem, domestic chip ecosystem, finding ways around the US dollar payment system in the future. That's what keeps them up at night. What they have to make sure they don't do is have too precipitous a sudden fall off in any of these areas of the economy that creates a doom loop of confidence that gets them into trouble. But significantly slowing growth, significantly slowing stock market, none of these things are priority ones for them anymore. Like I said, the party thinks it's doing a good job. It thinks it's steering it towards a healthier course going forward, even though foreign investors aren't very happy right now.
What's funny is you can see in these videos that some Western financial analysts, they get angry at the Chinese government. They're like, we don't understand why the Chinese government isn't like the capitalist US government that only cares about inflating the stock market bubble. But the next clip I'm going to show here is from an analyst who actually understands the Chinese economy much better. His name is Louis-Vincent Gave, and he is the CEO of a financial services company based in Hong Kong, which is called Gavekel, and they do financial research on the Chinese economy. And here in this clip, he explains how we cannot understand the Chinese economy through the lens of the US capitalist economy. And he points out that yes, the US financial markets are doing very well. The stock market is booming. The US dollar is very strong. But meanwhile, the US economy is not strong. It relies on massive government deficits. Poverty is horrible. Homelessness is horrific. Healthcare is more and more unaffordable. And meanwhile, the Chinese government is actually dedicated to growing the real economy and raising people's living standards, not inflating the stock market bubble. Here is a very interesting clip. And again, keep in mind, these clips that I'm showing are from people who work in the financial services industry. These are people who worked at major banks. They are not socialist activists, but some of them, like Gav, have worked in Chinese markets for decades and understand the system much better.
Look, there's so many different ways you could say winning. I would say starting off providing better life outcomes for your citizens, right? That should be number one. So perhaps the first hurdle should be to not have a falling life expectancy and not have a life expectancy that's at a 30-year low, which is where the U.S. is today. To not have a rising infant mortality rate, instead have a falling infant mortality rate. Perhaps winning is not having 1.5% of your population in prisons. I mean, lots of different ways. Perhaps it's not having a Gini coefficient that is increasingly looking like an emerging market Gini coefficient. I think part of the reason people latch on to the idea that the U.S. is struggling is because they don't rate what the country is doing on what the stock market is doing, but on what they see with their own eyes, with homeless crisis in major U.S. populations, with rising crime, with all these social factors that seem to show a society that feels rather sick, right? I mean, the U.S. today has the same life expectancy as it did 30 years ago, while spending as a percentage of GDP twice as much as it did 30 years ago on healthcare. So now maybe none of that has to do with the currency. So, but the reason I highlight this is that I think when Xi Jinping came 10 years ago or 11 years ago to power, and, Brent said, the stock market is down, 30% since then. I don't think Xi Jinping cares where the stock market is. Like, I really don't. I think in his long list of things he wanted to get better, it's not that the stock market was at the bottom of the list. It wasn't even on the list. I think what was on the list was moving more of China's trade to renminbi and to reduce the dependency of its economy on the dollar. Which it has been doing rapidly. And, this does take sacrifices. And if it means sacrificing the stock market again, Xi Jinping doesn't care for a very simple reason. And that is that while in the US, 70% of people own stock directly or indirectly, in China, it's between 10 and 12% of people who own stocks. And it's mostly the very rich. So if it goes down, it's like, who cares? It doesn't have the sort of social impact it has in the US. Not only that, but most companies in China don't fund their growth through the stock market. So I do think a lot of people look at China through the prism of the stock market, but again, I'm not sure it's that relevant to the leadership. They don't benchmark themselves on this. They're not like Donald Trump was tweeting each time the Dow Jones was up 150 basis points, saying, "Look at me, I'm doing a great job. The Dow's up 150 basis points." So it's a very different perception of how you judge yourself.
Now, the final thing that I want to look at today to understand how stock markets work in China, despite the fact that China has a socialist economy, I'm going to analyze a very interesting article by the analyst Glenn Look, who has also worked in financial markets for decades. Again, these are guys who work in finance, and they are not politically motivated to defend or whatever the Chinese system. They want to actually understand how the Chinese system works. And he wrote this over at his blog, which is called Reading, Writing, and Investing. And this article is titled The Paradox of China's Stock Market and Economic Growth. He notes that China has seen impressive growth in manufacturing in sectors like electric vehicles, but the market capitalizations of big Chinese companies are dwarfed by Tesla. Of course, Tesla is an example of one of these companies that has a massively inflated stock market capitalization because, again, the US government has inflated stock market value for decades, and the Federal Reserve printed trillions of dollars with quantitative easing after the 2008 financial crisis. And a lot of that liquidity went into pumping up the stock market, and especially tech stocks like Tesla. But continuing in this article, Glenn Look pointed out that China cares much more about GDP than market capitalization. In sharp contrast to Americans, Beijing just does not seem to care that much about equity market valuations, but does seem to care a lot about domestic growth and economic development. And those things are not the same. The stock market is not the same thing as the economy, as the real economy that provides tangible goods for people that they need to make their lives better, and not simply financial services in the fictitious financialized economy. Glenn Look, who is an American investor of Chinese descent, he pointed out that in the US, many, if not most of us, grew up equating the stock market with the health of the underlying economy. But in China, the situation is different. He acknowledged that in an economy, there is a contradiction between labor and capital. And it's funny because if you read this, it sounds like a Marxist wrote it. But again, this is not a Marxist. This is an investor who works in financial markets. But he acknowledged that in society, a balance must be struck in how economic gains are split between labor and capital, that is, profits on capital investment. And this is ultimately zero sum because $1 of economic gain can only be split between labor and return on capital. And he noted that compared to Western capitalist nations, in China, the general policy orientation is to favor labor over capital, especially privately owned equity capital versus state-owned equity capital, such as state-owned enterprises. What does that mean? That for the Chinese government, it is much more concerned about increasing income of workers and increasing revenue and return to state-owned enterprises. And ultimately, the government is not concerned about corporate private profits. And he notes that in China, you can see this in how so many of Chinese policies favor labor, especially low-income labor. For instance, the Chinese government has always maintained an exchange rate that makes sure that the yuan, the renminbi, is not overvalued, which helps to provide more industrial manufacturing jobs, which tend to be much better jobs for people. Because what happens is that when a currency is overvalued, the economy tends to financialize and deindustrialize. This is exactly what happened in the US in the neoliberal era. It's what also happened in Japan in the 1980s after the US imposed the Plaza Accord on Japan in 1985, which significantly overvalued the yen against the dollar, which led to the famous bubble economy, a huge asset price bubble in the Japanese economy in the 1980s, which burst in the early 1990s. And Japan has been in economic stagnation in the decades since, what are known as the lost decades. And a big reason for that was because the yen was overvalued, which hurt Japanese manufacturing and manufacturing workers. Meanwhile, Glenn Look pointed out that in China, the government has maintained a labor-intensive manufacturing model, which supports industrialization, not financialization, which helps working-class blue-collar workers, not white-collar workers who are working on Wall Street in banks, in marketing, in the financial sector. And furthermore, he notes that the Chinese government has maintained policies of stimulus, especially after the North Atlantic financial crisis of 2008-2009. It was not a crisis in China, which continued growing rapidly, but the Chinese government implemented a big stimulus, and a lot of that stimulus spending went into infrastructure and manufacturing and construction, which again benefited blue-collar workers in China. Meanwhile, this investor pointed out that China has notably cracked down on some areas of the private sector, like internet and finance, while encouraging others, like manufacturing. So clearly, the Chinese government, the Communist Party of China, has a policy of encouraging growth in the real economy, which employs workers in good manufacturing jobs, while cracking down on the fictitious sector based on financial speculation and big bubbles in the service sector that are not in the real economy. In this article, Glenn Look pointed out as well that state-owned enterprises play a disproportionate role in industrial sectors in China that are by nature capital intensive, and they are by far the biggest users of debt, and they get that debt from the state-owned banks in China, and therefore households and private sector business deposits, which are held in the state-owned banks, those are used to lend low interest loans at very favorable rates to the state-owned enterprises in the major manufacturing sector, which provide financing at a low cost. So that's another way in which we see that the state is helping to use these state-owned enterprises to maintain the base of the economy upon which the rest of the economy, the superstructure, is built. And finally, Glenn Look summarized this article saying that a consistent theme in Beijing's economic policy making is to prevent rent-seeking behavior by capitalists, especially those who have accumulated large amounts of capital. Instead, China would prefer that rent-seeking behavior is handled by the Communist Party instead, and then it can distribute these rents to the people. So what we're really talking about is public goods. Instead of allowing big private corporations to establish monopolies in banking, in utilities, in land, in what are the natural monopolies in the economy. That's what the US does in the capitalist system. Instead, in China's socialist system, the natural monopolies are provided by the state as public goods, by SOEs. And as this investor, again, I'm not reading an article from a socialist who's talking about why the Chinese system is superior. I'm reading an article from an American investor who works in financial markets. And he understands that in China, in Beijing, the question is whether or not it is better for the natural monopolies to be handled by the government or by private sector capitalists. And clearly, the Communist Party of China has provided a solution. The Communist Party will maintain a tight grip, if not an outright monopoly, on rent seeking. And those rents will be used to benefit the people and maintain macroeconomic stability, maximizing growth, but preventing parasitic rent seeking by capitalists. So today I have explained how China's economy actually works, how yes, China is still socialist. It's not the same model as the Soviet Union. It's a different model, but it is absolutely still socialist. And it is very different from the capitalist model of the United States and some of the Western financialized economies. And the US has tried to impose that model on the rest of the world in the name of so-called freedom and democracy. But in reality, because rent-seeking capitalist oligarchs in the US financial sector want to dominate the entire global economy. And this is why the US stock market makes up 60.5% of the value of the entire world's stock markets, all of them. And China, despite the fact that China has a larger economy than the US, Chinese GDP is larger than US GDP measured at purchasing power parity. Despite that, the stock markets in mainland China only represent 2.8% of the entire world's value of stock markets. Japan, which has a significantly smaller economy, has 6.2%, more than twice the size of the Chinese stock markets. And by the way, who has benefited from this US government policy of pumping up the stock market? It's the rich. It's not average people. The wealthiest 10% of people in the US own 93% of stocks. And according to Fed data, this is the highest level ever. Meanwhile, the bottom 50% of Americans hold just 1% of all stocks. So I repeat, 10% of the richest Americans have 93% of stocks. 50%, the bottom half of Americans, hold 1% of stocks. And by the way, it's not just rich people in the US who own US stocks. In fact, about 40% of the US stock market is held by foreign investors. Many of those are foreign capitalist oligarchs. So US government policy for decades has been to inflate the bubble of the stock market to enrich capitalist oligarchs in the US and around the world at the expense of average working people who have seen their wages stagnate and have to spend more and more money on basic services like healthcare and education and childcare. In China, meanwhile, yes, there are some billionaires, but they actually have been losing a lot of wealth in recent years because the government has been trying to encourage more and more equality in an idea what it refers to as common prosperity, trying to reduce wealth inequality. And a lot of media outlets have been complaining. And you also need to understand that billionaires and millionaires in China, most of their wealth is held in the form of stock in real companies that actually produce things, tangible technologies that make people's lives better, not in simply fictitious capital that's all tied up in financial derivatives and betting on the stock market. In fact, those kinds of capitalists, people like Jack Ma, they have faced consequences from Chinese authorities, often for violating the law, engaging in corrupt practices, and also for trying to challenge the state-owned banks and trying to create private financing. The government does not tolerate that. If you actually are going to create a company that produces things like electric vehicles, that produces things like technology that people want to actually improve their life, then China will allow you to grow that company, to become prosperous, to become rich. But your wealth is held in the form of those assets. But if you engage in risky behavior, like Evergrande did, and you take on way too much debt, if you, like Jack Ma, try to create private financing that can get poor people trapped in debt, or if you try to encourage inequality in things like education by creating private tutoring companies, which means that poor families won't be able to get access to as good education as wealthy families, then the government will not tolerate that. And those are some of the sectors in recent years where the Communist Party has cracked down in order to encourage more equality in education and to prevent private finance from challenging the state-owned banks. For China, the stock market is not that important. It is simply a tool that some companies can use to try to raise additional funding to invest in the real economy, in producing tangible products for people to improve their lives. It's not about pumping up the wealth of capitalist oligarchs like it is in the US. And that's why the US government has been dedicated to pumping up this bubble and making the rich richer and richer, while average working people in the US are living paycheck to paycheck. Poverty is getting worse. Violence is getting worse. Homelessness is skyrocketing. And the government doesn't really care because at the end of the day, it is big capitalist oligarchs and big corporations who fund US politicians who make policy on behalf of Wall Street. The Chinese system is completely different. It is a socialist system, and it truly is an alternative to the US capitalist system. On that note, I'm going to conclude. I'm Ben Norton. I want to thank everyone for joining me today. Please like and subscribe. Please share this, and I will be back soon. See you all next time.